All right, we're scheduled to start a new topic now, which is target target capital and optimal capital structure, and we'll get into that the next class, the next week of classes. We're a little bit ahead, not much, and I do want to try to get even more ahead because I want a little more time when we do asset valuations. But I think we can get optimal capital structure and the corporate structuring and mergers and acquisitions. I think I can do that in less than 2 classes, but we'll see. If we have to cut some stuff at the end, that's fine. So what I want to do is, instead of going to a new topic, I want to go back to an old topic. We talked about cost-benefit analysis, and I said do your cost-benefit analysis assuming whatever you're buying up front, that you buy that with cash, that you're not using any debt. And so now as you're starting to build your model, and you're putting all your assumptions into Excel, and you're starting to think about this concept of, wait, why are we ignoring debt? Because if I buy a car, if I buy a house, I'll certainly be using a car loan or using a mortgage. And so why don't we do that? And I'm arguing that's the correct way. Now I think this is an important topic. I have this debate with people from real estate. There may be, I think there's 1 or 2 real estate majors in our class. Real estate majors, real estate professionals love debt. They talk about how wonderful it is, that it increases the value of projects. But when I have those debates with them, I try to show them that I think they're making an error in the way they do the discounted cash flow. So let me see if I can demonstrate that to you. So let's say you have $1 million project and you're going to fund it half with debt and half with equity. So you'll put $500,000 down and you'll borrow $500,000. So here's your mortgage, $500,000. Remember, we did this with your Excel applications 2 and 3. We set up the present value interest factor annuity. There's our payments, there's our interest expense, and you can see the mortgage gets paid off at the end of 5 years. Now I'm assuming annual payments. I realize you do monthly payments. You will get the same answer where we do monthly or annual, but just to simplify things. Also, I'm not using that half-year convention we talked about. I'm assuming every cash flow happens exactly in 1 year. So let's compare a project where you do it all with equity. You put $1 million, all $1 million is your money, and then we'll compare that to having a mortgage. And we'll see what happens when you do that. So here's the project. It's $1 million project. Here's the benefits. Here's the net cash flows. And then here's your discount factors. And now net present value comes out to $114,000. You can use the NPV function in Excel if you like. Not the X NPV, because I don't have dates over here. The NPV function, you give it the rate. You highlight the benefits before discounting them. And then you add the upfront costs. And you can see you get the exact same answer. 114,257. So that's the net present value. I'm discounting each cash flow, and because I'm doing it annually, I'm assuming all these cash flows happen at the end of the year. So there's your net present value. Well, let's do it again now, but now let's put the mortgage in. But I'm going to do something that's absolutely incorrect, but just to prove a point, and then I'll change this assumption. Let's assume their discount rate with the mortgage and without the mortgage is exactly the same. It's 5%. Essentially what we're assuming is their cost of debt is 5%, and their cost of equity is 5%, no taxes, such that their WACC is 5%. And adding taxes in doesn't change this at all, so maybe I'll make that point at the very end. But so this is a simplifying of something that I will change later. It causes some problems when I change it later, but you'll see why that is. All right. So our net present value, if we don't borrow any money, our net present value is $114,000 using a 5% discount rate. Well, now let's do it with the mortgage. So if we do a mortgage, the cost of the project's $1 million, but we get $500,000 from the bank. So we're really only investing $500,000, but then our ongoing cash flows are going to be reduced because we have that mortgage payment. So our benefits are not $240,000 to $270,000. They're much smaller because we have to pay off the mortgage. And you'll notice when you do that, you get the exact same net present value as you would have gotten before. So there's my cash flows. There's my initial cost. And again, I get the exact same. So you can see if my discount rate is 5%, whether I use a mortgage or I don't use a mortgage, and my mortgage rate's 5%, the net present value is exactly the same. Now, here's where real estate people, I think, get into a problem, is they're using the debt when their cost of equity is actually higher. And so their WACC is actually 6.5%. It doesn't make sense for your cost of equity, cost of debt to be exactly the same. So if you're 50-50 debt and equity, and now your cost of capital is 6.5%, then what do you do? So here, we're going to do this analysis. Again, assuming no mortgage, and there's my net present value, and then assuming a mortgage. And we have to change our debt and our equity weights when we do this. And when you change the weights, you get a slightly different discount net present value. But so why are we doing it? So here, this is a little bit tricky to explain, but let's see if we can get this to work. So here we're assuming we're using debt in our discount rate. We're just assuming this $1 million, that this is both debt and equity. And in that case, we're using our cost of capital 6.5%. That reflects 5% cost of debt, 8% cost of equity. You have 50% in there. So it gives us a WACC of 6.5%. But we're assuming that we're using debt and equity because it's in our discount rate. So we don't need to set up the mortgage separately. The discount rate itself assumes we're 50% debt, 50% equity. And so when we do that, we get a discounted cash flow of $68,761. Down here, we put the mortgage in. When we put the mortgage in, we've taken care of the debt holders. They're taken care of right here. So these cash flows are only equity. These are only equity cash flow. If it's only equity cash flow, then we want our cost of capital to only be the equity cash flow because we're only using the cash flows that belongs to equity holders. In that case, our discount rate's 8%. And so we do get a slightly different net present value, but why is that? That's not because there's a difference. There actually isn't a difference between these two. And this is the tough part. Here I'm assuming our debt to equity remains equal 50% throughout. But you'll notice with this mortgage, as we pay off the mortgage, our debt starts declining, and so our weight of debt actually is increasing over time. And so these weights are just not exactly precise. If I mean exactly precise, I'll get these weights exactly right, such that I got these two to equal each other. Now, how do I do that? So I can take 1 minus 50% and say that's our weight of equity. And I'm going to take the net present value, assuming we have debt and equity, and the net present value is equity. And I'm going to tell GoalSeek, let's see if this works. I should have tried this in advance, but I didn't. We'll see. Sometimes it's fun for me to do things on the fly. I'm going to do GoalSeek. I want the difference in these two to be 0 by changing my average weight of debt. Let's see, there it goes. So you can see because my weight of debt actually declines over the loan, my weight of debt actually averages that out as 46% versus 54%. And when we do that, when we have the correct weight for debt, we actually get the same discount rate for both. I mean, the same net present value for both. However, what real estate people like to do is use the debt to actually give them a higher net present value because they're leveraging it up. But they don't take in consideration what they're doing actually is using, they're using the 6.5% cost of debt to discount their cash flows when they should be using 80%. And when they do that, they get a much higher net present value. So they're somewhat cheating. If you're going to do the cash flows net of debt, you cannot use your WACC. You can't use your WACC. You have to use your cost of equity. And so what they're doing is, let's see. So if you're 50, where's the example up here? So if, so here's what they should be using, 6.63. if they assume, that their cash flows are both debt and equity holders. They use 663. What they're doing down here is they bring the mortgage in. And so we got a present value of $65,000. Here they bring the mortgage in. But instead of using 8%, because remember the discount rate, if you do a net of the debt, this is only equity. And so they should be using a WACC of 8%, but they used a WACC of 6.63. And when they do that, they say, wow, look, the addition of debt increased our net present value by a good $21,000. Or you can say increased our return by, sorry, let me put a percent in there, by 33%. We got 33% more. Did you really get 33% more? No, you just used a discount rate that was way too low. You should have used an 8% discount rate, and instead you used a 6.63% discount rate. So what's the solution of this? The solution of this is to use your weighted average cost of capital, but only include all cash flows except for the mortgage. Leave the mortgage out. And so essentially what we're saying is this discount rate assumes you have the mortgage, because the discount rate is using weighted average cost of capital, which assumes a particular percentage of debt weight and equity weight. All right, I hope that makes sense. It's an important point. If it doesn't make sense, just put in your notes. I just proved to you that there's no reason to do a net present value analysis with a debt schedule in there. You don't need the debt schedule. Do it all as if you purchased all with cash. And then the discount rate you use for your project will reflect the fact that you're using both debt and equity. All right, so where are we going next in the notes? So we just finished enterprise value added, or economic value added. And so now what we want to do goes from there, and we want to ask. So we just did, and that's why one reason I want to do this now is we just talked about what happens to our cost of capital if we have 50% in debt or 100% in equity or 50-50, whatever. And so the question is there an optimal capital structure? What does capital structure mean? Capital structure is the percent borrowed versus the percent of equity. Is there an optimal capital structure? Should we use 100% equity? Should we use 70% equity and 30% borrowing? Should we use 70% borrowing and 30% equity? Is there an optimal level? What do we mean by optimal here? By optimal, we mean maximize the value of the firm. So we're going to get into this next week. If you want to read ahead, you can read the notes, but something I would recommend that you do is just type in Miller-Modigliani. You'll see it in the notes. The Miller-Modigliani theorem. And I'd recommend you read the Wikipedia and maybe the Investopedia if they have one. There's Investopedia, Wikipedia. If you want some advance on this. On the exam, what I'm going to do is, you see all these graphs that come up, like that one right here. On the exam, I'm going to give you one of these graphs, and on the exam, you have to explain the graph, which is essentially the Miller-Modigliani theory. And so if you want to read ahead, I usually recommend students start with Investopedia. That tends to be the simpler of the write-ups, and then go to Wikipedia, so you get much more extensive. Wikipedia might be, sometimes they use jargon that makes it a little more difficult, but you'll see they have one of these graphs in here. This is not the kind of graph I use. I'll show you the graph I actually use. If you're a finance major, I especially recommend that you read through the Wikipedia one. This is an extremely important concept, very famous in finance, and it's one of those, in my risk management class, we actually talk about this a lot because it's one of the theorems everybody learns. Everybody says, yes, 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 I understand it, but it's one that we violate a lot in our analysis, very much to our detriment. So I'll leave it there. That's it for this week's. And so next class we will start up with capital structure, optimal capital structure? Is there a way we can mix the firm's debt versus equity so that we can maximize the value of the firm?